So Fannie Mae, which is one of the largest backers of conventional financing, or largest backer of mortgage loans in the United States, has dropped the minimum credit score requirement of 620. So we're definitely going to talk about it in this live. So conventional financing is backed by 50%. 50% of mortgages are backed by Fannie Mae and Freddie Mac. Right now, Fannie Mae has currently removed the 620 minimum credit score that you need to qualify for conventional financing. So that has a lot of buzz going on in the real estate and mortgage industry. We're going to talk about the 620 requirement that they had. We're going to talk about the changes that they've made. And then we're going to discuss what I think is going to happen or could happen with those mortgage loans, right? So Fannie Mae had a 620 credit score, minimum credit score requirement to qualify for conventional financing. 620 is low for what they're looking for in terms of the borrower's stability, assets, and credit, right? So typically when you have a 620 credit score, most people don't think, hey, 620 credit score is a low credit score. That was the minimum score for conventional financing using Fannie Mae. However, they removed it. One of the reasons why they said they removed it is because they want to help try to create more affordability for home buyers. And I can see that, right? So when they say more affordability, there's different levels of credit scores. So I always say a credit score is not who you are. It's a picture of who you are at that second. Meaning if you have a 620 credit score and you have high utilization, 9 times out of 10, your credit score will increase when you pay down some of your debt. Now, what we're seeing is a lot of people saying, oh, they've removed the credit score requirement, which is not true. You still need to have a credit score. Just the minimum credit score requirement of 620 has been removed. Now, I want to preference this, right? If you got a 420 credit score, 5 lates, high utilization, constantly switching your job, a ton of debt, and no money, you're not going to qualify for that program, right? So the metrics that Fannie Mae is probably going to look at, and I've done some research, so they're going to look at job stability. Does this person stay on their job for extended periods of time, or are they hopping around from job to job? Is their debt to income ratio fairly low? Do you have fairly low income DTI, but your score is just sub 620, right? Do you have money? Do you have money in your 401k? Do you have money in your savings? All of these are parameters that Fannie Mae already looks at right now when approving a person. So if you ever hear somebody say, hey, desktop underwriting, that's Fannie Mae. We put the information in a computer. Fannie Mae, we run it through Fannie Mae for desktop underwriting, and boom, it tells us whether you can get approved, or it's either going to say approve eligible or refer with caution, or it could be refer eligible. So there's different metrics outside of just the actual credit score. People with bad credit, and when I say bad credit, I mean people with credit, with challenges, bankruptcies, cars recently repossessed, those type of things happen recently. You're most likely not going to get approved with Fannie Mae, even though the credit score requirement has decreased. And that's what I want to make sure I stress to you guys. They're not giving away homes. They're not giving away financing. You still have to have a decent looking credit profile to qualify for this program. The next thing is, when you go with conventional financing, they have something called PMI. Nope, Miss Jones, I'm sorry. I'm not sure what we had technical difficulties. There's something called PMI, private mortgage insurance. So on conventional financing, there's private mortgage insurance. On FHA, there is mortgage insurance. Two different things. FHA's mortgage insurance is a percentage of the sales price. Private mortgage insurance is where there's private companies who insure you based off of certain metrics. One of the metrics is credit score. So if we had a borrower who has a 620 credit score and they look at FHA and they look at conventional financing, and we just look at the mortgage insurance premiums, the mortgage insurance on FHA is going to be lower because it's a percentage of the sales price. On conventional financing, it is a risk factor. And that 620 could vary between two people. If you've got two people doing conventional with 620 credit score, one's putting down 10%, the other one's putting down 5%. The person putting down 5% is going to have better mortgage insurance because they're putting more into the deal. So just remember, even though they're reducing the credit scores for those programs, they still have metrics. And to me, I think it really only works for the person who is going to be able to put down a larger down payment. So ideally, if you have sub six, so let me preference, if I've never approved anybody conventional financing with a 620 credit score. .620 credit score, I've never approved anyone with conventional financing. That could change now, because if the person has a larger down payment and they have the right profile that conventional financing is looking for, there's still a possibility that you could qualify. Now, with the mortgage insurance piece, I think if you have a 620 or below and you have 20% to put down, so you don't have mortgage insurance, I think you have a better opportunity and better shot of qualifying. I actually spoke to one of our mortgage insurance representatives, and I asked her, hey, what are you guys doing? Because to get mortgage insurance, there's a minimum credit score. Well, one of the mortgage insurance companies has changed the minimum credit score to 600. So right now, if you have a 580 and you've only got 10% down, you're probably not going to be eligible for mortgage insurance. So a couple of things would potentially have to happen. Your lender could figure out how to do lender paid mortgage insurance, which is a totally different subject. Split it up between the buyer or buyer paid lenders insurance, mortgage insurance, or split it up between lender and buyer paid mortgage insurance, which helps you. Miss Jones, you got me off track. That's not Gucci Man in the background. The person, so paying more as a down payment helps you get rid of mortgage insurance, or figuring how not to get mortgage insurance by using a portion of your funds to pay out the mortgage insurance, or splitting it between having a lower mortgage insurance payment because you paid a portion of it. That's, I can do a whole nother video on that, because people get concerned with the mortgage insurance piece. But I think that sub 620, you have to have a large down payment, just like if you got 620. Realistically, if you got, matter of fact, let me give you a prime example. I reviewed a file. The borrower had a 653 credit score. They were putting down 5%. Their mortgage insurance, the house was $175,000 that they were looking. The price point was $175,000 they were looking to get approved at. Their mortgage insurance was $321 a month. $320.11 a month. That's a significant difference. On an FHA loan, that mortgage insurance would have been way less. So let me do the math. That mortgage insurance would have been about $80 a month. So that's a huge difference. That's probably $220, about $240 difference on the mortgage insurance, which means going conventional with a higher mortgage insurance, you qualify for $240 less than you would if you went FHA. So, them reducing the credit score is they're looking for ways to create affordability for people to buy houses. Conventional financing is very conservative. So they typically have the highest credit score requirement out of all the programs. Conventional financing typically has the highest mortgage insurance. Conventional financing also typically has the higher interest rates. So those things all calculate into your ability to qualify for as much as you need, or to qualify for how much you qualify for. Conventional is very conservative, and they want to make sure you have a decent credit profile. They want to make sure you have some assets, some reserves. Assets can be cash in the bank. Assets can be 401k, IRAs, insurance, that you can pull cash out of. So there's a lot of factors contributed to what you can do in terms of your credit score and being able to qualify for a mortgage with conventional financing. So again, a couple of things. They've also thrown out the 50-year mortgage. We talked about the 50-year mortgage. I've done a video on the 50-year mortgage. I'm actually probably going to go back and do another video on the 50-year mortgage, because as I learn and as I think about it, it can be looked at as pros and cons, right? So example, if you currently own a home, the average homeowner now they used to stay in their home between 5 and 7 years. Now the average homeowner is staying in their home 10 years. The average age of a homeowner now, a first-time home buyer, is 40 years. So if this 40-year-old buys a house and they stay in there for 10 years, they are now 50 years old, and to the point to where they could be thinking, hey, I want to look for my final home. Or if this is going to be my final home, I need some things to be different. I don't want to trek up and down steps. The kids are going off to college, or they'll be going off to college. We don't need a whole lot of room. Like, those are things that attribute to, them deciding to move. Or you decide, hey, I want to be closer to my grandkids or closer to my kids, and you move. Well, what you want to think about is, hey, a 50-year mortgage allows for me to qualify for more house. Yes, it is a long period of time. So if you take that same 40-year-old person that's buying a house and they get a 50-year mortgage, on paper, that house is not going to be paid off until they're 90 years old, which they may not see. The average life expectancy of an American is 75. Anything over 75, you're blessed to live, right? But at the same time, getting that 50-year mortgage to qualify so you can qualify for more house And then what you have to have is a game plan. You have to listen to the lender's game plan. You know, even when I tell people about purchasing a 30-year mortgage, because they can stretch the payment out longer and you pay one additional payment, and that takes that one additional payment a year and apply it to principal. That takes that from 30 years to 22.7 years. Or if you buy now and you're doing a 30-year or 50-year mortgage and you decide, hey, you know, when rates drop, I want to refinance, you can refinance out of a 50 into a 30 or out of a 50 into a 20, depending on if you have the ability to qualify. The 50-year mortgage could potentially work. It could potentially work, but the person has to have due diligence, and they have to be very conservative so that they're not stuck in that 50-year mortgage. The other thing about the 50-year mortgage, so what you guys may not understand, the shorter the period of time that you own the home, two things: the faster you build equity into the house and the lower the interest rate is on there. So if you looked at a 10-year mortgage, a 15, a 20, and a 30-year mortgage, the 30-year mortgage is going to have, without buying down points, the 30-year mortgage is going to have a higher interest rate, and the 10-year is going to have a lower one. So if you decide, hey, I want to do a 50-year mortgage, right now the numbers that people are giving you online, and even in my example, I use the same interest rate, but that interest rate is probably going to be a quarter more than what the 30-year is unless you buy down that rate. So your payment is going to be higher than what we typically calculate, but it will save you some funds in the immediate. But over the course of that additional 20 years, you're going to pay hundreds of thousands of dollars more. So if you decide, hey, I'm willing to do a 50-year mortgage if it can get me into the house that I want right now, just know that you need to have a game plan to utilize that 50-year mortgage to get you into a house. But then when rates change, things get better, you can refinance into a shorter period of time. The other thing with the 50-year mortgage is you build equity slower because more of the interest goes to paying down on the house. More of the payment goes towards the interest for a longer period of time. So currently, if you have a 30-year mortgage and you're paying the normal mortgage payment, majority of that mortgage payment and principal, when I'm saying mortgage payment, principal, interest, majority of the P&I is going towards the interest for the first 10 years. After the first 10 years, the bank has gotten the bulk of their money. And then from that point, you'll start to see it trickle down, and you'll start seeing where you'll be paying more of your payment going towards the principal portion of your mortgage. And somebody asked me, well, why would you pay down your mortgage faster? It helps you save money on interest, and it also helps you save money on interest over the course of the loan. It also helps you build equity, along with the equity that you get for the appreciation of homes. So guys, we're talking about the 620 credit score being removed. We are talking about housing affordability, and I threw in there the 50-year mortgage. If you have any questions pertaining to the 620 credit score, what thoughts that I have on it, definitely ask me in the comments. I am getting ready to get into asking questions. And before I do that, if you're watching this and you enjoy the information I provide, do me a huge favor, give me a thumbs up. It helps push it out to the YouTube algorithm. And what I have found is 53% of the people who watch my videos are not subscribed to my channel. If you could do me a huge favor, and if you're watching, just double check and see if you're subscribed to the channel. If you aren't, just hit the subscribe button and also hit that notification button so it lets you know when I go live. All right, and here we are. What's going on? Softer side of CC. I don't know what happened, Miss Jones. It said that I was canceled. That's why I was a few minutes late. Somewhere was a technical difficulty, probably on my side. Hey, Chanel, I'm hopeful that thing being strict throughout 2020 gets us into a home. Hopefully that being strict throughout 2026. Yeah, I'm gonna reach out to you and Isaac this week, and we're gonna go over a few things. And you're right. I just thought of it. That guy does favor Gucci Mane, but that's not him. That is a picture painted by a young lady out of Charlotte by the name of Whitney Austin. All three of them are. Matter of fact, we've got we've got multiple paintings throughout our house created by her. It was someone that we found. Well, say we. My wife found on YouTube, not on Instagram during the pandemic, and we just love her work. If we don't renew our lease and through if we don't renew our lease and tough it out in the truck for a year, will that affect the application when it comes to rental history? Yes and no. So the yes and no is um, if the scores are lower and it requires a manual underwrite, or if the scores are sub 640 and we need another compensating factor, and it on the application it asks us, does the borrower have a 12-month rental history? Sometimes that flips that manual underwrite to an approved eligible. So if you guys are going to tough it out in the truck for a year, I would say we got to do two things, and it would seemingly make sense that you're doing it. The one is make sure we get your credit scores up as high as we can, and two, if there's minimal room to increase the scores, then we need to make sure we have money set aside in terms of reserves. And typically, it flips it when you're maybe 640, 650, and below, and you're also trying to do down payment assistance, get a gift from a family member, and or seller's assistance, which each one of those things puts in a different layer of risk, and with the credit score being where it is. So we can work on those. I mean, whatever you want to do, we can try to figure it out. But the key is increasing the scores and saving bread. So you pay more interest through it. It's a no for me for the 50-year mortgage. 30 years is already insane. It is. And this is where I'm battling with. Realistically, like I researched it and I'm battling. I see where I can put more people in homes because they qualify for more. They can qualify for more. And this is just an example. Taking someone from a 30-year mortgage at maybe, let's say, qualifying for 250 and going to a 50-year mortgage, saving them, let's say, $200 a month, that may take them from 250 to 285, 290. And that puts them in a different ballpark of the type of houses that they're looking for. The goal is, listen, guys, even though you're in a 30-year mortgage, hear me and hear me out. The goal is never to pay that mortgage for 30 years. You understand? Like, never. The goal is never to pay the mortgage for 30 years. You want to pay it off because at the end of the day, you're paying double or paying triple if it goes to the 50-year mortgage. And you want to be able to see how you can take funds and pay down on the principal. And by paying down on the principal, you pay that house off faster. Because, I mean, granted, it's another 20 years. Let's take that 40-year who buys. Who wants to be paying a mortgage at 70? Like, there's options. I've seen people take a higher rate, be in a better position, refinance, and they refinance, they get a lower interest rate, they take a shorter term, their payment may be the same or a little bit higher, but they pay it off faster. So the key is finding the cash or figuring out how you can pay your home off faster. Because 30 years is insane. It's a long period of time. I know in other countries, 20 years, 5 years, and then they reevaluate it. So, 30 years is a long period of time. The goal is to pay it off faster and sooner, save hundreds of thousands of dollars. So you're paying it off. But in order to do that, you need to be disciplined. And I could not think of that word for some reason. You got to have discipline and able to do that. And it doesn't have to be one payment at a time. It could be a portion of that one payment. If you say, hey, first quarter, you say your mortgage payment is $2,000. First quarter of the year, by the first quarter, I'm going to pay $500 towards my principal. Second quarter, I'm going to pay $500 more towards my principal. Third quarter, I'm going to pay an additional $500 towards my principal. And then the fourth quarter, you pay an additional $500. That's $2,000 over the course of a year. And it has the same effect of paying one full payment at a time. So like paying that off definitely, it helps decrease the amount or the period of time that you have the mortgage. Okay, Miss Jones. So it's not that credit scores are no longer applicable. Conventional financing had a 620 credit score minimum to qualify for conventional financing. They've removed that 620 credit score requirement. However, you could have a 600 and still potentially qualify, but you still have to be approved. You can have a 700 and you still got to be approved. So there's no minimum requirement, but there's minimum metrics that they have. So they're not saying, hey, you can have a 450 and qualify. Most likely, if you got a 450, I don't know at this point if the private mortgage insurance companies will even go that low, or your mortgage insurance would be insanely high and it won't make sense unless you've got a 450 credit score and you got 20% to put down into the deal. And then at that point, me as a loan officer, I would probably help you increase your score so you can potentially get better terms. So there's a lot to be had right now. I think they're throwing so Fannie Mae is not a throw out there thing. It's going in effect as of today, November the 16th, 2025. It goes in effect today. It could help some people who have sub 620 credit scores, but a decent profile, and they could potentially be looking to refinance. That could help tremendously, because then that could help that person get rid of mortgage insurance if they have an FHA loan. And then the only difference is they'll probably have a higher interest rate with conventional financing, but that all depends, And when we talk about mortgage insurance on FHA loans, $100, $150 a month, but that makes a difference. That could be the difference in you being able to, pay an additional bill with the increase in electrical bills, gas bills, utility bills in general, cell phone bills, car insurance, all that stuff is increasing. So that, that could help. So, we start today. We'll see where it goes. I have a few scenarios in my system that I'm going to run to see if it makes a difference in whether that person can qualify or not. And if it does, or if it does not, I will let you guys know in another live. Ms. Jones, let me know if I answered your question or got you up to date. Facts. I'm 1 year in and already looking for different ways to pay my house off already. So softer side, that's what's up. I I'm not sure if you get a tax return, but if you do, you could use a portion of the tax return to pay down, apply the principal. Um, you can, you know, I'm not going to say have a yard sale. You can figure out how to sell something. You can look at your budget and see where you can cut things, and the things that you cut, you can apply towards your mortgage. Um, but it also depends on your mortgage interest rate, right? Um, if it were me, and this is what we're doing, we're paying down credit card debt and any additional type of debt first because those interest rates are higher. And as we get rid of that debt, then we'll take whatever's left over from that debt and we will pay down on the mortgage. And that way, you also want to make sure before you start paying your mortgage down, that you have 3 months of reserves available in savings. As a matter of fact, I'm going to do a live on that, like the order in which you should pay down your debt. And contrary to what people believe, I think that paying down your mortgage should be the last thing, because you want to make sure you have a supply of money in case something happens. Because even though you may have a lower mortgage principal, if life happens and you need money, it's tied up in the property. And if you can't refinance, then you're stuck. You're still kind of tied in the property. First thing to do is looking at your budget and seeing what you can put towards your principal or paying down your debt. I would see if you can pay down your debt. And again, go in your closet and see what you can sell, what you don't use, what you don't wear, things around the house that you can sell. Like, be resourceful, and see what you can do. The biggest thing right now, debt is a crutch. It's a choke. It has people in a chokehold. And I think we need to figure out how to get from underneath some of this debt so we can live a little bit more freer and enjoy life. Yes, you may have the ability to pay the minimum payments every month, but if you stretch that out, it's going to take you 7 to 8 years to pay off that debt. So I get it. I would make sure I would pay down before I pay down on my mortgage. I pay down on credit card debt, car loans, or anything like that. And then once you have all that squared away, start putting that additional funds to paying off your house. But I'm going to do a video on that because I think that's very helpful to people, especially going into the new year. No, Ms. Jones, it does not affect FHA, VA, USDA, or even Freddie Mac, which backs conventional and guarantees conventional financing. It's just Fannie Mae, because FHA's minimum credit score requirement is 580 if you're putting 3.5% down, and it's 500 if you're putting 10% down. So it only affects conventional financing. 620 credit scores have been removed. Are there stipulations on some loan agreements where you can't rent out your home within a certain time frame? So typically, if you are doing straight FHA, VA, USDA conventional financing, you need to stay within your home for a year, for 12 months, before you can move or rent it out, right? Technically. If something happens and you have to move, and you have to move across country and you can't sell your home or don't want to sell your home, then, it's an opportunity that you can move out. Now, the biggest stipulations are when you have a down payment assistance program that you use to acquire your home. Then that's where the larger stipulations are. I've seen some programs you can't rent out your home for 10 years. if you rent out your home for 10, within that 10 years, they are looking for you to pay that loan off because it's no longer your primary residence. So those would be the longest and biggest stipulations, but that depends on what down payment assistance program, if you did or you utilized to purchase a home. Hey guys, let's reset the room. We are talking about Fannie Mae removing the 620 credit score requirement to purchase a home and get approved. It does not mean that FHA has removed their credit score stipulations, VA, USDA, bank statement loans, or anybody like that. It also does not mean there's no credit score not required. It just means they've lowered the bar and you have to have some sort of established credit score, and you need to have an established credit profile. So if you got bad credit, I would still work on increasing the score, and then also seeing what you can save. And I have seen some people with lower credit scores, and that's just because they may have high debt, or they had low scores, but they sold their home and they have a chunk of money. That may now allow for them to qualify. So it will help in some fashion. You just need to make sure you have a loan officer that knows how to give you your best options and advise you on the best things to do. I've even seen some people say, hey, that additional $250, $212 that I'm saving, that I can save on my mortgage, I can invest that in the market and make a higher return. It just all depends. If you're new to the channel and you're watching this now, I want to say thank you for joining me on a Sunday night. If you could do me a huge favor, if you have not already done it, is hit the thumbs up to push me out to the YouTube algorithm. Also, if you're watching and you're not sure if you subscribe to my channel, if you could do me a huge favor and hit the subscribe and notification buttons, that will tell you when I'm going live, when I've promoted when I've put out a video. So do me a huge favor. Also, we have an amazing Facebook group that if you would like to join, the link will be below. It's free. You can jump in, you can get some motivation, you get some information on mortgages, you can see success stories. Do me a huge favor. And if you're watching the live or you're watching the replay, comment Facebook if you are a part of my Facebook group. Now, I also have a newsletter. The newsletter goes out multiple times a week. It always is about what videos are coming out, when I'm going live, what videos are out, a compilation of the videos that I put out for the month. So that typically happens at the end of the month or the beginning of the next. And then typically we'll have maybe an article about something going on in the real estate market. If you are already a part of my newsletter, if you're watching it, comment in the chat. If you're watching the replay or now, comment newsletter so I can know who's all in the newsletter and if it's even worthwhile doing. I appreciate you guys in advance for what you're doing. And, if you have any questions right now pertaining to home ownership, I'm here to answer them. Home ownership, I'm here to answer them. Anything, if you currently own a home and you have questions about refinancing, let me know. So let me know. Yeah, Chanel, I appreciate you being part of the tribe. You, Facebook, YouTube, all of it. Yep, she got the books, everything. She locked in. I will say I appreciate your support. And we will get you guys into a home. The other thing is we're approaching towards the end of the year. And it's holiday time, and a lot of times people who are on their mission to purchase a home slow up a little bit because they say, oh, it's holiday time and I'm just going to wait until the beginning of the year. And what I would tell you is do not take your foot off of the gas. Continue to press forward, because holiday times don't really mean anything if you're working on your credit, if you're actively looking to purchase a home. Everybody's not going to continue looking. They're going to stop for the holidays. And if you're looking and other people aren't, that means there is less competition. There's going to be less competition out there for you if you're looking to put an offer in on a house. I'm going to be old and gray before I'm able to buy a home. Shaking my head. I've watched you and Shahida and just daydream. Miss Jones, have you jumped on a call with me before? I don't think so. And if you have, I could be wrong, but I don't think so. Let's take action, guys. Let's take action. There's also, I put out a video yesterday. You won't till you're ready. Okay, no pressure, but I'm here to help you get ready. Because if you don't know what to do to get ready, then you'll never be ready. Right? I've seen people waste thousands of dollars doing the wrong thing. My consultations are free. I spend time with you just talking about your situation privately. And, we do a credit pull to see how we can get you in position. And you may have already had that with somebody else and you're like, hey, I know what I need to work on. That's cool. But sometimes those algorithms change over the course of time. And when I say algorithm, I'm talking about credit score. And we can see what we can do to help speed up your process. But if you are, as you say, I didn't say it, old and gray, and you buy, you still had the ability to purchase. If you have kids or family members, you've got something to leave with them. And then we teach you how to pay your house off early so you get to enjoy it. Also, I take care of a lot of people. Okay, cool. Well, that's cool. No pressure. You know what to work on. That's cool. I appreciate you joining in when you do. I specifically make sure I get these videos out for you before the Housewives of America come on. So I appreciate it. Again, guys, if you're watching this live and you have questions pertaining to home ownership, let me know. If you have a topic that you would like for me to do a video on or discuss, do me a huge favor and let me know. I'm doing some videos on topics that people have given me. I will be putting them out. Also, I wrote a book. My book is Student Loan Debt No Problem: How to Successfully Secure a Mortgage with Student Loan Debt. This book will help you in these times where they're not trying to forgive student loan debt. People are getting late, 90-day late, 120-day late. I don't know what's going on late on their student loan debt, and it's wrecking their credit as well as their opportunity to purchase a home. This book right here is currently on sale for $24.99 or $24.88. You can go to my website, www.peopleslender.com, and purchase it there. I also have a home buyer's journal, which I don't have near me. I'm sorry. I have a home buyer's journal that you can purchase as well. Both of those are great resources to help people, or they could be great stocking stuffers for people in your family. Yes, Miss Jones, I will. I'm gonna stick it here too, and then I'll make sure it's in the description. What's going on, Natural E? It says, yes, you must get out of student loan debt. Never get in it if you can't help it. You're right. Um, there, student growing up for me, the what was uh, pegged as the American dream was going to college, getting a degree, so you can get a good job. Get a good job, you can become a homeowner. Homeownership and degrees were pegged as the American dreams. Right now, some people are considering American nightmares, and they regret getting a ton of student loan debt. And a lot of times, student loan debt could affect your ability to purchase a home. What we have to do is we have to work with the younger generation and educate them on the student loan process and actually college in general, right? When I say college in general, you've got to make a decision if you really want to go to college. Right now, this is just personal opinion. It's just me, it's Kevin Jefferson, right? Right now, unless you specialize in medicine, a nurse, psychology, or a psychiatrist or a lawyer, degrees really aren't worth the paper that they're printed on. Yes, you get great experiences in colleges. Yes, you get an opportunity to meet some great people in colleges. But for 50, 60, $100,000, I can meet somebody somewhere else. Um, we need to teach our kids about trades. I read the other day that Ford Motor Company has 5,000 jobs available for mechanics because they can't find enough mechanics to work. And the average pay for those jobs are $120,000 a year. That's with no degree. You can become a mechanic by going to trade school and learning the trades and getting certified. And I'm sure whatever you need to do to once you get your foot in the door, Ford Motor Company will teach you what they need you to learn. I'm starting to see more kids say that they're skipping out on college and they want to learn a trade, whether it's a electrician, a plumber, HVAC person, welder, um, whatever. Really, you could be a realtor. That's considered a trade. A loan officer, that's a trade. No degree required for either one of those positions. I think there's options outside of going to college. I mean, like you can rack up 200. They will give you $200,000 for college faster than they will give you $200,000 to start a business or $200,000 to buy a home. Like you can get that college debt and just rack it up. There's a ton of things that I wish I had done differently when I went to college, but I was the first in my family that I knew. Well, my brother went to community college for a couple semesters. My cousin went to community college, but no one said I was the first one to go to a 4-year school in my immediate family, and no one had did it. So I was the guinea pig. If I had to do all over again, the difference that I had from those student loans, I would probably send that money back to the student loans, those refund checks back to the student loan servicer instead of spending them. Or probably when I think about it, I would probably have saved those and at that time took that money and purchased land to get into real estate. Soft aside, I appreciate that. Hey, listen, if you have the journal and it helped you, if you could email me a review on the journal and let people know, hey, this journal helped me through my process. Some people, I didn't like when I initially did it and I went through Amazon, I didn't even know who had the journal. So people would tell me, oh, I purchased a journal, and I knew I was having sales, but I didn't know who they were. And it would be people who come to me and they would buy a house, say, hey, I got your journal also, and it helped. I'm going to use it. Using it now and talking to you about the mortgage side, and I use it when interviewing my realtor. So yeah, definitely do me a huge favor and let me know how those journals work out, and I appreciate your support also. Yeah, like agree. 51K, I end up becoming a truck driver, no degree needed. Nope. Nope, nope, nope. Yep. I mean, I told a kid, what people don't understand, you can make doctor money in the trades with less education and less debt. And it's not even necessarily, having a big corporation. It's owning your own small business. That I talk to HVAC guys, electricians, plumbers, and they don't have anybody to pass that down to that's interested in the trades, because it's not a sexy job. Some people say, oh, I'm a plumber. It doesn't have the same weight as, oh, I'm a nurse, or I'm a psychologist, a psychiatrist, or orthodontist, or something like that, or pediatrician. But you can make the same, if not more, money than them. So trades are a great opportunity. And in trades work, if the real estate market is booming, they're building houses, trades are utilized. If the real estate market is stagnant and they're not building, trades are utilized, because people are fixing up their home, they're getting new toilets, they're getting new showers and tubs, they're getting new lighting, adding additions to their home where they need plumbing, heating, electric, and HVAC. All of those things are worthy of doing, because you can make a great amount of money. It says, I need to become a mechanic ASAP. I wish I had did some things. I don't know. I wish I had learned some other things. And it's still not too late. But real estate is a trade. I remember when I was in college and I was looking through the course booklet, they were supposed to be offering a real estate class, but they could never get enough people to sign up. So I've always for the longest had a want to be in real estate. I remember being in class with a girl who was a realtor while we were in college. So yeah, I've always wanted to do real estate in some fashion. Can you recommend a good real estate agent in New Jersey that are knowledgeable about all the programs and that will get into a home? All right. So it's not necessarily the realtor's responsibility to know all of the programs. But if you tell me which part of New Jersey you're in, I can refer you to someone who knows who knows how to navigate through those waters. Me and my team, we can help you in Jersey in terms of a mortgage. But yeah, you also want to have a realtor that's knowledgeable about negotiating, because I've been seeing some not so experienced or not so knowledgeable agents who, not saying they're purposely not doing the best thing for their client, but they just don't know and they don't ask and not willing to take any suggestions. So all of that plays a part into getting into a home. But if you tell me what part of New Jersey, shoot me an email. I'm gonna put my email here. shoot me an email, tell me what part of Jersey you're in, and then I can see how I can help you. Thank you, Miss Jones. I know you're going to watch your shows. You're probably gone now. Cool. So, guys, this has been great. If you have any questions pertaining to home ownership, I got a couple more minutes that I can answer some questions. If you're just watching the replay or you're just joining the live, we talked about Fannie Mae removing the 620 credit score requirement to qualify for a mortgage. That does not mean that FHA, VA, USDA have removed their requirements, and neither has Freddie Mac moved the requirement. It's just Fannie Mae right now. What I will say is typically what Fannie Mae does, Freddie Mac follows suit with something similar. So let's be on the lookout for that. The purpose of doing that was to create more home buyers who, to get more home buyers to qualify for conventional financing using Fannie Mae. But again, there's more to it. And something that I did not talk about, and I may do a video on it as well, is that the government, Fannie Mae and Freddie Mac are quasi-government entities, right? And they support 50% of the mortgages in the United States, which means they secure a lot of debt. However, they're looking to send them to privatization. So they're looking to privatize Fannie Mae and Freddie Mac. So the lowering the credit score, getting more people into homes helps them create more income, stretching out mortgages to 50 years helps them have income for a longer period of time to make it look more profitable and robust for someone on the private side to purchase Fannie Mae and Freddie Mac. Let's keep an eye out on that as well. Union County, New Jersey. All right, let me take a note. RC, can you send me an email? And then we'll connect. Cool, guys. So I am Kevin Jefferson, the People's Lender. Before I go, I'm going to say this one more again. If you're watching this live and you have not subscribed to my channel, do me a huge favor, hit the subscribe button. And if you are subscribed to the channel and you're watching it, and if you're not subscribed to the channel and you're watching it, whether it's the replay, hit the thumbs up. It helps me push it out to the YouTube algorithm. Thank you guys for coming out. I'm Kevin Jefferson, the People's Lender. Have a great night.